Every economy has limited resources at its disposal. Government of an economy should make best use of those limited resources in order to maximize social welfare. In making the decisions of how much of a public good to provide, government uses social cost benefit analysis, which is a fiscal instrument intended to improve the efficiency of public sector budgetary decisions. Resource scarcity would mean making choices among various projects or proposals or investment decisions. Therefore, different alternatives need to be compared before making a choice. Cost benefit analysis is an economic tool which provides simple and practical assessment of various available options. It is the general methodology that has been developed to make expenditure decisions by the legislator or the executor. Social cost benefit analysis refers to a systematic and formal method of evaluation of the public expenditure. It takes a broader view of all benefits and costs than just considering financial profitability. It involves accounting exercises which compares costs and benefits of public goods projects. It provides consistent basis for assessing whether a project should be undertaken or if there are many options, which project or projects should be undertaken. Project evaluation determines the ways to make the most efficient use of scarce resources. The basic issue involves the determination of composition of the budget or allocation of total funds among alternative projects. Project evaluation involves determination of the appropriate size of the budget. In other words, there are various situations in which one needs to understand the size of the budget and in others the composition of the budget. It also depends upon whether projects under evaluation are divisible or lumpy in nature or indivisible. To understand these situations, assume that benefits and costs are known. Now, depending upon the nature of the project, whether divisible or lumpy, and budget, which is fixed or variable, some decision rules have been developed which apply in the selection of projects. We will explain these situations in detail and the respective decision rule in each case in this module.
After studying this module, you shall be able to know the concept of social cost benefit analysis, learn various decision rules for project evaluation, measurement of costs, and discounting technique. The government or an economy should make best use of those limited resources in order to maximize social welfare. In making the decision of how much of a public good to provide, the government uses social cost benefit analysis, which is a fiscal instrument intended to improve the efficiency of public sector budgetary decisions. Social cost benefit analysis refers to a systematic and formal method of evaluation of public expenditure. It takes a broad view of all benefits and costs than just considering financial profitability. It involves accounting exercises which compares costs and benefits of public goods projects. It provides consistent basis for assessing whether a project should be undertaken or if there are many options, which projects should be undertaken. A project is considered worthwhile if net social benefit, defined as excess of benefits over costs of a project, is positive, or if benefit cost ratio is greater than 1. As benefits and costs of large projects accrue over a number of years, the need is to summarize these streams of benefits and costs accruing over a number of years. The formula used to calculate net social benefit is equal to present value multiplied by the difference between benefits and costs. Project evaluation determines the ways to make the most efficient use of scarce resources. The basic issue involved is the determination of composition of the budget or allocation of total funds among alternative projects. There are various situations in which one needs to determine the size of the budget, and in others, the composition of the budget. It also depends upon whether projects under evaluation are divisible or lumpy in nature. To understand these situations, assume that benefits and costs are known. Now, depending upon the nature of the project, divisible versus lumpy, and budget, fixed versus variable, some decision rules have been developed which apply in the selection of projects. Let us now discuss the principles of project evaluation. First, we will start with divisible projects and fixed budget size. If all public projects are finally divisible, that is, may be changed by small amount, then the best way to allocate a given sum between any number of expenditure projects would be based on equalizing the marginal benefits from the public projects. This equalization of marginal benefits from various public projects maximizes the sum of total benefits derived from all the projects. Divisible projects and variable budget size. If the budget is fixed, the opportunity cost of pursuing one public project is defined by the benefit lost in terms of not pursuing another public project. In variable size budget, opportunity cost of public projects is the benefit lost by foregone private projects. In such a case, the best way to allocate resources is to maximize net benefits, that is, benefits minus costs of both public and private projects. Lumpy projects and fixed budget size. The best way to allocate resources is to choose the project mix so as to maximize the net benefits subject to some qualifications, that is, leftover funds are worthless. For example, the table shows various projects 1 to 7 and respective costs and benefits. Supposing the fixed budget size is $700,000. Experimenting with various combinations of the projects reflects that net benefits are maximized when projects 4, 1, 5, and 2 are chosen. Total cost is $695,000. Benefits are 1,120,000 and net benefits are equal to $425,000. $50,000 remains unspent. If we consider this unspent amount as worthless, the above rule gives the best project mix in the current situation. Lumpy projects and variable budget size. In a situation with no fixed size of the budget, the best way to allocate resources is to choose all projects which yield positive net benefits. It is so because in case of lumpy projects, benefits from marginal outlays cannot be equalized. Therefore, it would be proper to undertake a public project so long as the benefits of the project exceed its costs. Let us now understand benefits. In a broad sense, it includes the extent to which objectives are attained. As Good explains, benefits may include increases in consumable output, improvements in the distribution of welfare among consumers, and gains in the capacity for national independence. In cost benefit analysis, generally only real benefits of a project are considered. Real benefits are classified as follows: direct versus indirect, or primary versus secondary, tangible versus intangible, intermediate versus final, inside versus outside.
The benefits of a project may be differentiated as real or pecuniary. As explained by Musgrave and Musgrave, real benefits are the ones derived by the final consumers of the public project. Pecuniary benefits come about because of the changes in relative prices which occur as the economy adjusts itself to the provision of public service and the pattern of resource demand changes. In this case, gains or losses of some individuals are offset by losses or gains experienced by others. As a result, pecuniary changes do not reflect net gains or losses to the society, but real benefits and costs reflect an addition to the community's welfare and reflect net gains or losses.
Costs represent the foregone opportunities which are measured in terms of prices paid for inputs, consisting of capital costs and operating costs. This approach, as used by accountants, is known as cash flow accounting approach to measure costs and benefits of a project. Social marginal cost of a resource is measured in terms of opportunity cost of that resource, that is, the value of that resource in its next best use. Examples of opportunities include using land in a different or more valuable way than its current use, the alternative use of an employee's time, and investing in a public transport system instead of building additional roads.
Costs can be valued in real terms or nominal terms. Since real prices eliminate the impact of inflation and make comparisons more consistent, measurement is generally done in real prices. Further, market prices are normally used for estimating costs as their identification is easy, but market prices do not account for various imperfections and distortions in the market, such as monopoly pricing, externalities, etc. And in some cases, market really does not exist and it is not possible to observe prices and estimate costs. For example, environmental and social costs. We call such things as intangibles. Their prices are not directly observable due to missing markets. There are techniques to put a value for costs, benefits of tangibles in the analysis. The costs represent the foregone opportunities which are measured in terms of prices paid for inputs consisting of capital costs and operating costs. This approach, as used by accountants, is known as cash flow accounting approach. This measures the costs and benefits of a project. But to determine the optimal level of public goods, the concept of social marginal cost is used. Social marginal cost of a resource is measured in terms of opportunity cost of that resource, that is, the value of that resource in its next best use. Examples of opportunities include using a land in different or more valuable way than its current use, the alternative use of an employee's time, and investing in a public transport system instead of building additional roads. In these examples, the opportunity cost represents the next best alternative foregone in favor of the taken up opportunity. The opportunity costs are reflected in market prices. For example, the market price of a land. The social marginal cost of an input is determined by its market prices, but by the next best use to which the input can be put by the society.
Now we will move to the estimation of costs. In conducting an analysis of various proposals, the first step is to identify all the relevant costs, and the next step is to assign monetary values to these costs. It can be valued in real terms and nominal terms. Since real prices eliminate the impact of inflation and make comparisons more consistent, measurement is generally done in real prices. Techniques to put a value for costs, benefits of intangibles in the analysis are: shadow prices are used in cases where market price does not reflect the true cost of a good or service to the society. Revealed preference testing assigns a value to a good which is not traded directly in the market using the value of a related good being traded in the market. Stated preference testing estimates a consumer's willingness to pay for a good or service or willingness to accept compensation for consuming a bad, such as pollution, or tolerating a negative economic output by conducting surveys in hypothetical markets.
We need to understand the fact that benefits and costs do not accrue only instantaneously but also over time. For example, one time costs of a project have to be combined with the future stream of costs. Since cash flows from investments occur in the present as well as future points in time, same weight cannot be given to the flows occurring in different time periods. The technique of discounting is used to assign weights to these streams of earnings occurring over a number of time periods. Generally, the cash flows occurring sooner are given more weightage than flows occurring later. Discounting technique gives us the present value of all streams of cash flows. The present value of various projects can be effectively used for making a rational choice among projects. Let us now illustrate different types of costs and benefits. In the case of irrigation projects, the real benefits can be both direct or indirect. The direct can further be tangible or intangible. The tangible could be the increased farm output or the costs of pipes. Intangible may be the beautification of an area or the loss of wilderness. Indirect could be classified further into two forms, tangible and intangible. The tangible benefits or costs includes reduced soil erosion or diversion of water. Similarly, the intangible benefits could be the preservation of rural society or the cost could be the destruction of wildlife. Pecuniary benefits could be higher real income of farm equipment or industry. The pecuniary cost could be the real increase in the land values at Cape Kennedy. Similarly, in the education project, we can study the real and the pecuniary costs and benefits. Real benefits can be both direct and indirect again. The direct benefits or costs can be the tangible, for instance, the increased future earnings, or the tangible cost could be the cost of teachers' salaries, the cost of buildings and books. Similarly, the intangible direct benefits could be enriched life, or the direct intangible cost could be the foregone leisure time. Similarly, the indirect tangible benefits could be the reduced cost of crime prevention, and the intangible benefits in the indirect form could be more intelligent electorate. Similarly, the pecuniary benefits could be the relative increase in teachers' income.
The technique of discounting is used to assign weights to the streams of earnings occurring over a number of time periods. Generally, cash flows occurring sooner are given more weightage than flows occurring later. Discounting technique gives us the present value of all streams of cash flows. These present values of various projects can be effectively used for making a rational choice among projects. Present discounted values for social investments are calculated using an appropriate rate called the social discount rate. In case of investment decision making by a private firm, an appropriate discount rate represents the opportunity costs of the funds in question. In the case of governments, it is the private sector opportunity cost. The discount rate chosen should not include the effect of inflation. The formula that can be used to remove the effect of inflation from discount rates is 1 plus nominal discount rate divided by 1 plus inflation rate and then subtract 1 from the equation. Let us now discuss the rationale for discounting. The first justification for discounting future flows is that, in general, a person would prefer to receive a rupee now rather than tomorrow. Another justification is that, while assessing a proposal, a person would desire a return from the proposal which is higher than return from any other venture of equal risk. Discounting determines the net benefit or cost over and above the return from other ventures of equal risk. If net present value (NPV), aggregate discounted net cash flows over the period, is greater than zero, it indicates that the return is higher than in other proposals of equal risk, and if it is negative, then vice versa. A value of zero indicates an equal return. In this way, several projects can be compared on the basis of NPV. Discounted value now can be calculated by multiplying future value in the nth period to the discount factor in period n, or multiply future value in the nth period to 1 by 1 plus discounted rate times n.
Let us now summarize what we have learned in this module. Social cost benefit analysis considers all the relevant positive and negative impacts of a project to be undertaken and quantifies these impacts in monetary terms. It helps in analyzing whether a project is worthwhile to be undertaken or not. A project should be undertaken if net benefits, that is the discounted value of benefits minus discounted value of costs from the project, are positive. Further, in a project appraisal, basic question is whether a project increases net social welfare. It requires estimation of various costs and benefits of the project. At first step, the identification of all significant tangible and intangible benefits and costs is required. After identification, their measurement follows. If gain from measuring a specific cost of benefit is outweighed by the cost of its measurement in terms of resources devoted towards measurement, then it should not be included in the evaluation. Discounting technique is used as part of cost benefit analysis. It reflects that value of a cost and benefit now is greater than its value in future periods. Therefore, in the process of evaluation, a discount rate is selected to reduce the value of future benefits and costs in order to express these at today's values.